So, welcome everybody to the ITESOFT Duty to Report Payment Practice webinar. It is great to have you all with us. Our apologies for this morning and the issues we had with the audio at that point. We're not quite sure where we went wrong, but hopefully this is clearer and easier for everybody to hear us and see the slides and hear it at the same time. So, first and foremost, what I wanted to talk to you about today is the duty to report payment practice legislation that's come in and why it's been introduced by government and what they are doing to achieve their aims through this. So I think the key thing they're aiming for is to try and redress the balance between large organisations and small businesses. And the perceived imbalance and power, particularly around payment of invoices. And as you can see there from Margot James, who's the minister responsible for this piece of legislation, there was a reported excess of almost 27 billion that was owed from large organisations to small organisations beyond agreed payment terms when the government were looking at this. So they've tried a number of things over the past. They've tried some various ideas to get people to sign up to best payment practices, but have now come to the conclusion that full legislation is required for controlling this process and trying to equalize that balance between the two types of company. So, having introduced this legislation, the first question really is, who is it that has to report on this? And as you can see, there are three key criteria. Any organisation that meets two or more of the three has to submit this report. And companies consist of both registered companies but also LLPs and also subsidiaries and parents, and all of the individual subsidiaries would need to submit individually. And if you're the parent of a series of subsidiaries, then you will also need to submit. The rules for the parent are very slightly different than the numbers you can see here, but they are affected too, so please, you will need to do it. So in general, you need to have a turnover of 36 million or a balance sheet of 18 million or employ over 250 people. This is all about your UK turnover or your UK operation. So if you're international, it's only about the UK part of it. The estimate from government around how many people are affected is that this is going to impact about 15,000 organisations. In terms of what you need to report, the report itself is broken into three areas. There are some specific statistics around how you're performing, how quickly you're paying your suppliers. Then there are a series of statements, almost yes/no answers really. Do you offer this? Do you allow for that? Can your suppliers, for example, submit e-invoices? Do you offer early settlement payments as standard? And then finally a narrative where, in answer to some specific questions, you have the opportunity to explain why you're doing what you're doing. So before we progress, we're going to just do our first poll. And just ask everybody if you could just respond to this and let us know what your key payment terms are at the moment, and whether you are having to respond, are offering your suppliers a standard payment terms of 30 days or less, 30 to 60, or above 60 days. So thank you for replying to that for us. And it's interesting to see from the results of that around about 2/3 of you are having standard payment terms of 30 days or less, but a good 10% of you have still are having a standard payment term which is actually greater than 60 days. In terms of the statistics themselves that have to be reported, you have to show the percentage of your invoices that you've paid within those three bands, and perhaps the one that will attract the greatest attention externally the percentage of your invoices that you have not paid within the terms that are agreed between you and your supplier. So in order to calculate this, you need a good understanding of when your invoices have arrived, and the government have determined what timeline they consider for an invoice. So for them, and for the purposes of this report, day one is the day after the day you receive it. So whether you receive that invoice through the post or electronically, you have the first day essentially to get organized, and then the clock starts ticking on the following day. The end of the period that you need to count is the date on which the supplier receives payment. So if you're paying them by check and you're sending in the post, you need to allow for the period of time it takes for that check to get to them. If you're paying by transfer, obviously that's much quicker, and so you can allow for that more easily. So that is the time frame that they are considering for their figures. The only get out of jail that you have for this is if the delay is caused by an external factor, and the only valid external factor that they've suggested so far is a failure of the bank payment process. So if you've submitted a bank payment request for funds to be transferred, and for some reason the bank has an issue and it doesn't transfer the funds within the 24 hours you were expecting, but takes longer, that is not your fault, and you can report as if they had received the funds when you were expecting them to. If there is a dispute around an invoice and you are unwilling to pay whilst that is being resolved, then that invoice still has to count in your statistics, but it will only appear once in the statistics, and the period of time in which you will have to report on it is based on the date that that invoice is due to have been paid, based on the terms you have between yourself and the supplier. But if the dispute runs on for many weeks or months or years even, then you don't have to report on that invoice each time you're reporting. I mentioned the narrative section, and here you need to talk around your standard payment terms, the standard length of time, as you've just let us know in your poll, but also what is the maximum period you have a contractual agreement with a single supplier. And this is where the narrative part and the ability to explain what you're doing is much more important, because you may have standard terms of 30 days but a single contract with a single supplier that's much longer than that, and this at least gives you the opportunity to explain why you're in that situation and why you've chosen to do that. It also gives you the opportunity to explain how you will handle a dispute when one happens between yourselves and your supplier, so that you can at least provide some justification and explanation as to what's going on in your process. So when do you have to report? Well, the legislation kicked in from the start of this financial year, from April the 6th, and you will have to report twice. The first report that you have to deliver, it needs to be submitted 30 days after your half year. So the kind of trigger point is your financial year end from whenever that is after April 6th, 2017. At that moment, you then wait 6 months for your half year, and you then have 30 days to report on that 6-month period. And then at your next year end, another 30 days after that for you to report and submit this report on what happened in that last 6-month period. And that then continues every 6 months going forward, so long as you continue to qualify based on those criteria at the start. If in one financial year you shrink as an organisation and fall below 2 of those criteria, then in the following financial year you wouldn't need to go through this process anymore. Some consequences. This is government legislation, so there is a stick that comes with it for failure to comply, and if you do not publish within that 30-day period, or if you knowingly report invalid information, then it is considered a criminal offence, and if you're found guilty of that, then there is a fine associated with it that will be applied that fine and the criminal record will be applied to both the business and to either the company directors or designated members if you're an LLP. So it will hold a personal impact to key members of the company, as well as just a reputational image damage to the company itself. Obviously, failure to comply will have reputational damage, and particularly at the start of this process, I'm sure that it will be widely reported if organisations do fail to match up to this requirement, and they will be clearly mentioned and made. The press will, I'm sure, jump on that at the start, and there will also be an impact to your suppliers, who will want to understand why it is that you're not prepared to publish this data, and particularly if they're having uncertainty, or perhaps for new suppliers that you wish to deal with, it will give them a level of uncertainty in terms of dealing with you, which may have additional impact on you as a business. So that is the overview really of what this report is around, why you need to fill it in, how you need to fill it in, when you need to fill it in, and what happens if you don't. So I think what we would also now like to go on to and talk around for you is what you can do to make sure you're ready to deliver on this. So first and foremost, what you need to understand is your processes within your organization today, from the moment that invoice arrives at your organization to the moment you have paid it and that those funds have made it to the supplier. So you need to understand both how invoices are received, where they're received, to make sure that you can record that receiving moment. You then need to understand your process about how you go through authorization of that invoice so it's approved for payment, and then also the payment process itself, so that the suppliers can receive that payment and you know how they're going to receive it, when they're going to receive it, and therefore what your stop date is on that individual invoice, so that you can report accurately on that process from start to finish. So we're going to just hold a second poll quickly now, just for those of you that are there, to let us know what you think your processes are, and how, very simplistically, you process invoices from start to finish, whether it's a manual process or whether you have some automation, or whether you have outsourced this process to a third party, just so we can get a bit of a feel from that from yourselves. So thank you for doing that. And what we can see from that is around about 20% of you have got a sort of fully automated optical character recognition and workflow solution in place, and actually around about 45% of you are still working on a manual process here. So for those of you on a manual process, obviously having a real detailed understanding of what's going on in that process is really vital, and making sure you're able to record that start and end point is going to become really key to what you're doing. So once you've understood your process, then it's a case of looking as a business at what you're doing and why you're doing it. So if you have got long payment terms and they're deliberate and it's a business decision to have those in place, then you obviously have the narrative to explain why, but it's important that as a business you understand why you've been doing this, so that you can explain it or choose to address it. So there may be very good reasons. You may have a trading arrangement with a supplier. The goods may be being shipped to you from the other side of the world. You may receive the invoice when the goods go into the ship, but obviously you may have an agreement that says you're not going to pay until those goods arrive back in the UK, and that could be 90, 120 days. That makes perfect sense. You can talk about it and explain it. But it may be that you're doing it for cash flow reasons, or it may even be that your process is so inefficient that that's the quickest that you can agree is a 60-day or whatever term to pay your suppliers, and actually therefore by reviewing that process you can understand how can we improve that and could we bring these payment terms down. So once you've understood why you've got them, it's important for the business and ultimately the board who are going to be signing off on these reports to consider for you as an individual business and an individual organization, what are the pros and cons of these long payment terms? If we were to reduce those payment terms as a business, what will that do? If we keep them, what is the external perception? How will that be viewed now this is public knowledge by our competitors, by our suppliers, by the press? What are they going to think of it? How are we going to be perceived? And what is our reputational impact of doing this? Do we need to address that and do something about it before we start reporting, or as part of our reporting process, so that we're already on top of this? And then, if you have got long payment terms, is it something that you're offering, you only offer to all of your suppliers, or are you able to actually start to look at some of the suppliers that you have and see if there's a way of reducing those payment terms as standard for certain set of your supplier base? Could you offer better terms for some of your smaller suppliers? That is the intention of this legislation. So if you can be seen to be meeting the intention behind it for your smaller suppliers, then that will come across well and help with the reputation of your organization to the external world. Secondly, then, having understood your process, it's important to also try to see, well, are we making late payments because of internal issues? And what are we doing and why are we doing that, and how can we look to address that? Some of the key areas that it's worth reviewing are your purchasing processes and your purchasing strategy as an organization. From an invoicing perspective, do you have a no PO, no pay policy, which means that unless the invoice has a purchase order associated to it, you're not going to pay it? Even if you do have that policy and your purchase ordering system is in place, how simple is it to use? How efficient is it? How easy do your business users find it to raise orders? It's all well and good having lots of purchase orders being raised by the business, but if every invoice that comes in is for a completely different value and number of goods to what you thought you'd ordered, then it's not saving you a huge amount of time, and you've still got lots of discrepancies to manage. So making sure that your purchase ordering system in the first place is efficiently used and effective means that you are able to process those invoices more quickly. Can you understand where your problems are within the business? Are there particular bottlenecks? Are there particular parts of the business that are slow, particular steps in process that are slow? And do you know where an invoice is at any time? So are you able as a business to identify invoices that are coming up towards their payment date, and therefore, in order to achieve success within the statistical requirements, need authorization and a payment? Can you track down where in your business they've got to, who it is that is responsible for final authorization of them, and how you can go through that? Is it worth considering an approval process for some of your invoices maybe that works on an assumptive approval, and that you give the business time to come back and dispute the invoice, but otherwise you assume it's okay and pay? Is that a sensible approach for you as a business? All of these things need to be thought through, understood, and considered in relation to the impact of not doing it and the potential negatives that might happen from a reporting perspective. Generally speaking, all of these issues can be tackled by looking at that process, spotting where things can be enhanced and improved, and streamlining process, and also through the use of technology to enhance and improve the processes that you've got within your purchase to pay process. So just looking a little bit more at how technology can help. Technology really can help in two key areas. Firstly, there's a manual processing element with invoices that happens, and as we saw earlier, almost half of you are still manually processing these invoices. So technology can enable you to capture the invoices the moment they arrive at the business. More and more suppliers are looking to send invoices to their customers in quicker and cheaper ways, which means rather than printing them out, sticking them in an envelope and putting a stamp on it, that may cost them almost £1 per invoice, if they can email it as an attachment directly to you, that saves them that £1. It also means it gets to you immediately, not in 2 or 3 days, so they're able to accelerate the process from their perspective. However, for you as an organization, what happens when those invoices arrive? Where do they go? Who receives them? What happens to them? How quickly can you get them into the system? By using technology, you can automate that process and you can centralize that process, so invoices are sent to a shared mailbox rather than to multiple people within the business, and then you're waiting for time for them to arrive. Similarly, through the use of scanning, you can turn the paper invoices into electronic invoices again very, very quickly. This type of technology can improve the throughput in terms of invoices processed per FTE within your AP team by 3 or more times in terms of their turnaround. And it will give you automatic integration with most of the technology that's available today into your ERP system, so that invoices are automated through that process, and again, removing that manual process, increasing the speed with which documents go from receipt through to payment. Secondly, technology can also help looking at accelerating the speed with which the invoice is coded and authorized and approved. You can use it to standardize the process to make sure that there aren't different business units or silos within your organization where the approval process is more convoluted. You can use it obviously to confirm against auditing that the right people are approving the right levels of spend. You can identify bottlenecks. You can start to name and shame. You can use the technology to report on those areas where invoices are always authorized and approved quickly, and those areas where they're very, very slow. And you can start to therefore focus time for you into that business sector, what needs to be done to help them to improve what they're doing. Do they need help around their procurement processes? Do they need help to understand what the invoicing is? Do they just need shouting at? You can manage that process with them. Also, with technology, you can improve the authorization processes. If more than one person needs to authorize a document, then the manual process requires that document to be moved from person A to person B through the internal post potentially. That may even be from one physical location to another. That introduces risk of delay and risk of invoices getting lost. Technology can ensure that that happens instantaneously. Technology can also ensure that those approvals can happen in parallel to allow a much quicker turnaround time. And it also gives you reporting functionality to see where all of those invoices are at any time. So the technology that's out there will enable you to manage that process much more easily and efficiently, both to generate the individual statistics, but also to ensure that you are able to pay as many of your suppliers as possible within the terms that you've agreed with them, which I think is the key and probably the most important measure within this duty to report legislation. So finally from us, just to have a look at what some of the benefits can be to looking at your processes, understanding them and refining them beyond avoiding a criminal sanction and a fine. There are a number. Streamlining the process for your accounts payable team, possibly through automation, possibly through technology, but even just looking at the process and looking at how it can be enhanced will improve the throughput. It will free them up from spending all their time chasing invoices around the business, from manual doing entry, and allow them to focus on the value add tasks and dealing with discrepancies, managing the relationship with the supplier more effectively. Analysis of TOPS performers shows that companies with the highest levels of technology and the highest levels of automation are able to achieve in excess of 60,000 invoices per annum per FTE, which is an enormous enhancement on a manual process, which rarely sees much above 10,000 for that. Second benefit beyond it is the opportunity to make use of early payment discounts. Two ways of going around this. Obviously, the earlier you have authorization internally and freed up the invoice ready to pay, it may be the supplier just offers an early settlement discount, and you can make a business decision as to whether you want to take that or not, and whether to pay them early for the discount they're offering you. Alternatively, you can start using it for a dynamic discounting process. You now have the invoice ready to pay. You can go back to the supplier and offer them a reduced payment, but for early payment, and then it's up to them to decide if they want to take that or not. But you can help that. That will help ensure your suppliers are being financed in a way that's efficient and effective, and particularly today with very low interest rates, the value to you as an organisation and your Treasury Department of having this cash sat in the bank is not huge, and it may be that it's of much greater value to your supplier, and actually you can get in essence a higher return by paying early than you would have done an interest in investing that money somewhere else overnight. And research shows organisations that look at this and do this very efficiently can make savings of up to £1 million for every billion that they're spending. So fairly significant, 1% savings to you as a business, and obviously that frees money both to be reinvested within the business and to borrow some nomenclature, to make your accounts payable team a profit earning centre rather than a cost to the business. It's also really helpful to be able to use the analytics that are provided as part of this, and the analysis that you've done enables you to have a much greater control over your spending, a much greater control over the purchasing that's happening, and a better understanding of what you're spending, when, why, and that leads to a higher level of decision making and how you're going to interpret what to do, the investment decisions that you may want to make as a business. It will reflect into better supplier relationships, being able to notify suppliers of when they're being paid, suppliers to understand that the proportion of their invoices that will be paid on time, allows you to build better relationships with them, which will enable you and them to develop your business and theirs going forward to be mutually beneficial. Improved understandings gives greater control of where people are at in terms of spending their budget, and allows that level of control from within the finance team to manage what's happening. And then, having looked at this process and having streamlined that process, it puts you in a much better position to simplify it. And a simplification of a back office function, which is the procurement process and the invoice processing process, means that the impact to the business of every time they raise an order or every time they have to review an invoice is reduced. Simplification of that means they're spending less time doing it, which means they can spend more time doing the job that they're employed to deliver on and on their core task, which means hopefully a better delivery from the business and a higher profitability, which is the target. So in summary, thank you firstly for attending, and apologies again that you're having to listen to this as a recording rather than the original for our sound issues this morning. I think, as you can hopefully see, the government is aiming through this to try and redress the balance between large organisations and small organisations. There is a fairly high overhead in having to generate this information, and there is a high risk of reputational damage if you as an organisation either fail to comply with the duty to report requirements, and there is also a potential risk to your business's reputation if you have very poor payment practices, either very long payment terms or you're very bad at paying your suppliers within the agreed terms. So key to that is looking at what you can do and how you can improve things. We at ITESOFT offer technology to help support this. If there's any further information that you would like around how we can help, please get in touch. The details are on screen now. We will also be sending out to you details of a link to a white paper that explains in a lot more detail a number of the things that I've been talking through, and explains specifically the details of the Act and what you have to do and how you have to deliver on it. And Finally, if you need any more information, there are links available from that white paper directly to the government's own legislative documentation, and you can wade through the 130 odd paragraphs that explain this in perfect detail. So thank you again for your time, and we look forward to hearing from you soon.